Economic data coming out of the UK recently have been very weak, so in this video we look at what that means for investors, both for the UK equity market, but also how it affects UK currency, which affects foreign asset investments, and the UK housing market. So if you do want to learn more about investing, remember you can always join us as part of our community for just $10 a month. You can now pay in sterling, and there'll be a link to that in the description below and above me. So let's look at the UK recession in a bit more detail. This is not a recommendation. If you want advice tailored to your specific circumstances, seek independent financial advice. Let's start off by looking at UK growth. As many people expected, the second quarter of 2020 was the biggest hit in terms of the pandemic's effects, and UK GDP fell by about 20%, which is the largest quarterly fall on record. If we compare that with other major economies, the UK comes out very poorly. There are many reasons for that, but the heavy dependence of the UK on the service economy is certainly one of them. And also, as we'll see later, the actual effects of the pandemic on the UK have been very severe. And one of the consequences of the lockdown was that instead of going out and spending money on things such as restaurants and leisure, we were forced to stay at home, and that money consequently found its way into our savings. If we look at the household saving ratio, that underwent a huge increase to almost 30%. And for UK businesses, that was certainly a problem, because money that we're saving, we're not spending on those goods and services which they provide. And it's worthwhile taking a brief look at how the UK is doing with COVID. Our World in Data has incredible interactive graphs where you can actually track a country's cases versus many other countries. In this version of the data, we're looking at the daily new confirmed COVID-19 cases since the confirmed cases reached 30 per day. And it's pretty clear that in the UK at least, those confirmed cases are increasing, and the number of positive tests is also increasing, which you can tell by the colour of the line. Also, note that this is a logarithmic graph. So although it doesn't look as if we're far above Italy and Germany, in terms of the actual number of cases per day, we're much higher. So we have almost 16,000 cases per day as I make this video in mid-October, whereas Italy and Germany are at around 5,000 cases per day. And because COVID is back on the rise in the UK, the government's had to create this three-tier system such that when regions reach a higher level, they get increasingly stringent rules as to how people can behave. But if you look at any of the time series in any of these countries, almost all of them show massive fall in activity followed by a big rebound. And although we haven't quite got to the rebound yet, NISA, which is an economic research organisation in the UK, produces this monthly forecast for UK GDP, and they expect that in Q3 2020 we should get that big rebound in activity. However, they do say in their report that that depends completely on the kind of lockdowns which we get and on the spread of coronavirus. And certainly at the moment, it looks as if we are going to get tighter lockdowns in the months ahead, and that'll inevitably create a further drag on the economy. A key measure of how healthy an economy is the level of employment, and its flip side, which is the unemployment rate. Now that's not the number of people who are out of work as a percentage of the population. Instead, it's a proportion of the economically active people who are currently unemployed, where economically active means that you're currently in work or you're seeking and available to work. So for example, it excludes people who've already retired or people who for reasons of ill health are unable to work. Another measure of employment is how many hours we work in total, and that shows that despite many people being shown as being employed, the actual hours which we're working in the UK have fallen dramatically. And although there has been a significant pickup in the few months leading to August, we're still far below the levels we were at before lockdown started. And more worrying still, the rate of redundancies is increasing dramatically, and that's despite many of the furlough programs still being in place. In fact, it looks quite plausible that the rate of UK redundancies will reach the levels we saw just after the global financial crisis. And that's because this reaches far deeper into the UK economy, into the service sector, than the global financial crisis did, which primarily affected the financial sector. If instead we look at the UK claimant count, which is how many people are claiming unemployment benefit, that's increased by over 120% since March 2020. And if you have become unemployed, the problem is that there simply aren't that many job vacancies, because during this period of increased uncertainty and less demand for goods and services, employers are less likely to hire people. But what's interesting is the Office for National Statistics has really raised their game as a result of the crisis, and they've started producing really timely data which updates almost on a weekly basis. So here they've got data from Springboard and the Department for Business, Energy and Industrial Strategy, which looks at the footfall index such that before lockdown is rescaled to 100%. So footfall fell by about 80% in the early stages of lockdown. It gradually recovered. Then when pubs were allowed to reopen, it increased a bit more. But since we've had this 10 p.m. curfew on pubs, it has fallen off slightly. They also break it down into 3 sub-indices: a high street index, but also retail parks and shopping centres. And it's encouraging to see that the retail park index, at least, is almost at levels that we saw before lockdown. That's certainly good news for the UK retail industry. A lot of UK wealth is tied up in house prices, so that's certainly something which is interesting to most Brits. And what's interesting is that house price growth has started to accelerate again, both in northern England, which is shown in red, and in southern England, which is shown in blue. One of the reasons for that is that many people delayed their decisions to move as a result of lockdown, and now what we're seeing is some of that pent-up demand being released. The UK government also introduced a stamp duty holiday, so many people have brought forward their purchases to avoid stamp duty. And we've also seen some behavioural shifts after lockdown, because after being cooped up in our houses, many of us realised how awful life is without a garden. In fact, if we look at a regional breakdown for the reasons why people are moving, over 40% of the respondents in London said they were considering moving as a result of their experience since the COVID-19 outbreak. And if we look at whether people are moving to regions which are more urban or less urban here on the right, certainly for the 55 plus age group, there's a huge shift to moving to less urban areas. But you can also see that bias even in the 18 to 24 year age group. People who are considering moving or have already moved, over a quarter of them are citing access to a garden or outdoor space as the reason for that move. If we look at the annual change in house prices, as usual, we can see a huge difference between regions, with the annual change in house prices being greatest in the southwest, at about 5.5% year on year. If we look at the regional house price change on a map, you can see that the southwest is currently where house price growth is greatest. The economists at Nationwide think that the house price growth acceleration may be short-lived. Firstly, because the labour market conditions are going to weaken significantly, but also because tighter restrictions are going to reduce economic activity. And also the furlough scheme at some point will have to wind down. One of the key things which drives UK house prices is economic growth, but also wage growth. And in an environment where we are seeing higher unemployment and weaker activity, we're not going to see much wage growth. And also that tends to depress house prices. Now let's turn to the UK equity market. It's always useful to get a perspective on the size of the UK equity market, and if we look at the weight of the UK in global indices, you can see that it makes up just 4% of MSCI World, which captures most of the market cap in developed market equity. To first order, developed market equity is the US, which makes up over 2/3 of that market. In fact, if we look at the market capitalization of the UK, it's comparable with just one stock in America, which is Apple. The sector composition, which is the kind of industry breakdown for UK equity, is also very unusual. The red bars show you what the sector composition is for MSCI World, which is developed market equity, and the blue bars show you the sector composition for MSCI UK. Notice how many of the bars are very different in size. If I simply look at the differences between those two, you can see that the UK has a massive underweight in information technology. There just isn't much in the way of tech in the UK equity market. And then there's a huge overweight in things such as consumer staples, but also materials, which is mostly miners, and lots of energy companies, which are mostly oil and gas producers. This sector composition has certainly hurt UK equity returns, because the best performers over the last decade have been those tech stocks, whereas energy companies have been very hard hit by the fall in the price of oil, and lower economic activity has reduced the price of materials. Financials have also suffered because interest rates are low, which hurts their profits for lending, but also their cyclical stocks, which depend on economic activity and tend to do badly in a recession. One of the things which the UK has really got going for it is that it's relatively cheap, both compared to its own history and compared to other equity markets. Barclays produces this cyclically adjusted price-to-earnings ratio for many countries, including the UK, and you can see that that peaked in the dot-com bubble, then UK equity derated downward significantly down to about 15 times. It rose slightly up to the global financial crisis, and after the global financial crisis, it really hasn't gone anywhere. So currently, investors are willing to pay very few pounds for every pound of UK profits. The CAPE multiple is less than 15 times. If we look across multiple countries to see whether their CAPE is currently expensive or cheap compared to their own histories, we can see that the UK is certainly one of the cheaper countries. The CAPE multiple in the UK has been higher than it is currently 83% of the time, going back to about 1980. That's in very stark contrast to the USA, which has only been more expensive than it is currently about 11% of the time since 1980. So if you are a contrarian investor, then you might see this as an opportunity if you think the market's priced in too much doom and gloom into the UK equity market. If we look back to 2010 and we look to see how much money we'd have made if we'd have invested £1 into each of these different funds, MSCI UK would only now be worth about £1.50, as would the FTSE 100. And these are accumulation indices which also incorporate the very big dividends that UK companies tend to pay. If we look at UK mid-caps, the return has been a lot better. We'd have more than doubled our £1 over the last decade. But we'd have done much better if we'd have diversified into developed market equity. In that case, we'd have more than tripled our money. If we look at that on a risk-return plot, where we've got risk along the bottom with high risk on the right and low risk on the left and returns on the y-axis, I've shown the returns for the life strategy funds, which go from 20% equity all the way up to 100% equity, and compared that with MSCI World, the FTSE 250, the FTSE 100, and MSCI UK. And for this level of risk, you can see that you'd have done much better either by buying a global equity fund, such as Life Strategy 100, or even better, go for something like MSCI World. And one of the reasons why Life Strategy 100 has not done as well as MSCI World is that it has a very large overweight for UK equity, which, as we've seen, would have been a drag on returns. Even the return on the FTSE 250 isn't as impressive when we consider that we could have got equivalent returns by taking much less risk. Life Strategy 40 only has a volatility of about 6%, whereas the FTSE 250 has almost triple that volatility, but only comparable returns. So for most UK investors, they look to diversify by investing globally. And if you do that, then the relative strength of sterling versus foreign currency suddenly becomes very important. If we look at the value of sterling versus the US dollar in the top panel, and this graph goes from the beginning of 2020 till mid-October, I've also shown sterling versus the euro and the value of the S&P 500 in the US. What's very clear is that when equity markets sold off in March, so did sterling, because it's no longer seen as a safe haven currency. So if you do think equity markets are going to sell off, then that weakening of sterling would favour foreign investments. And if we extend that period of time all the way back to 2005, the dashed lines here show crises. So this was the default of Lehman Brothers in 2008, this was the Brexit referendum result in 2016, and this was the pandemic equity sell-off in 2020. And you can see that after each of those events, sterling weakened versus the dollar and versus the euro at the same time that equity markets were falling. But looking at the upside, if things do improve and there is more risk appetite, then all of these arguments would work in reverse. And that would tend to flatter UK assets or currency hedged funds where the effect of the currency is removed. So it's certainly not all doom and gloom. And remember, things will eventually improve, but it's very hard to see that now that we're at the probable low point of the crisis. But if you do think that the UK has been unfairly punished in terms of valuation, then perhaps this presents an opportunity to you if you're a contrarian investor. If you do want to learn more about economics and investing, another way is to click on our free weekly market roundup. The link is just up there above me. So that's PensionCraft.com market roundup. And you can always join our online community for $10 a month. And the link there is on the far side of the page. So we'd love to see you as part of the community. And as always, thank you for listening.